Hi, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 50, titled Exit Strategies Must Be Timed Properly. And we're going to use a real-life example with MGM Resorts International, which trades on the New York Stock Exchange under the ticker symbol MGM. Now, exit strategies for covered call writing is the third required skill for becoming an elite option seller. Of course, we have to select the best underlying securities, select the best options, and once we're in the trade, we have to know how to manage them. And all the trades regarding exit strategies start the same way. We buy back the initial short call, buy to close. Now, there are other considerations as well regarding how and when to implement these exit strategies. For example, an exit strategy earlier in the contract may be different than the ones we would implement later in the contract. And the reason for that has to do with the Greek theta, or time value erosion. Now, our option values will decrease regarding its time value component every calendar day by its theta. So theta is always a negative number. Now, theta is logarithmic in nature for near the money strikes. It's not linear, which means that it starts out very slowly and then picks up steam as we head towards expiration. So later in the contract, time value is eroding rapidly, and there's less opportunities to generate additional time value credits. That's why I'm willing to spend more to close an option earlier in the contract than I am later in the contract. And this, of course, will alleviate our calculation considerations, because the reason we're using these strategies is to generate cash. We have to keep in mind and focus like a laser on what our strategy goal is and how to manage our positions based on that. So let's turn to a real-life trade that was shared to me by Clark, and thank you very much, Clark, for sharing your trade. And it's with MGM and for the July 17th, 2020 contract. So here's how the trades went down. On June 8th, so it's 5-week expiration, Clark purchased 100 shares at $23.18, and then that same day sold the July 17th, 26 out of the money call for $1.54. Now, just 4 days later, the price of the stock started to decline significantly. This was during the coronavirus crisis, and there was quite a bit of market volatility, and certainly casinos weren't doing too well during this time. So the price went down, which caused the premium value to go down, directly related to share price decline. So what Clark did was he buy to close the 26 call for 54 cents. So he sold it at 154 and bought it back at 54. So there was a credit there. The question is, was this timed properly? So we're going to get into that in this podcast. Now, on that same day, Clark then sold the July 17th, 19 call. And so he rolled down $7 a share from 26 to 19 and generated a premium of $2.38. So that was the rolling down trade that was initiated on June 12th, just 4 days after opening the trade. Now, on 6/21, MGM was trading at $17.17. So that just shows you how much volatility there was with this trade in a negative direction. So the question is, should the rolling down strategy should have been implemented? And if so, should it have been implemented on June 12th? Now, if we look at a price chart of MGM during that time, we would see that up until June 1st, this stock was on a tear in an upward direction. It had a huge upside from about $13 up to about $24 in a very short time frame. Now, what happened was after the trade was entered, it started to decline in value. Like I said, during the coronavirus crisis, the market was very volatile, and a good part of it was to the downside. So the trade was entered on an upswing, and then Clark rolled down when it started to decline in value from the 26 to the 19 strike. And then on expiration, the stock was trading at 16.33, so below the 19 strike. So that's what, if you can visualize, those of you not watching the podcast, if you can visualize that, a spike up, went down, and then it went down even further. So let's break down this trade into 4 separate categories. We're going to look at the initial structuring of the trade. We're going to look at the buy to close trade, the sell to open trade, and then should there be any exit strategy execution after the sell to open rolling down trade? Should there be an exit strategy in place? So let's have a look at those 4 categories. First, the initial structuring. Well, if we feed it into the multiple tab of the Elman calculator, with the stock at 23.18, 26 out of the money strike generated 154. Now the calculator shows us that the time value return, initial return, was 6.6%. Wow, that's pretty significant for a 5-week return. Not only that, but the upside potential at that point in time, if MGM moved from 23.18 up to the 26 strike, would have added another 12.2%. So there was a max 5-week return of 18.8%. Now that tells us right off the bat that there was huge implied volatility with MGM at that point in time. And for many investors, myself included, this would not have been an appropriate underlying to use. That doesn't mean it's wrong to use. That means that based on my personal risk tolerance, this would be too risky a stock. Of course, a high implied volatility means, yes, great premiums, but also greater risk to the downside. So I shoot for 2 to 4% a month for my initial time value return. This one was 6.6 with huge upside. And once again, nothing wrong with it if it does align with your personal risk tolerance. Now let's look at the second category, the buy to close trade, which was initiated on June 8th. At that point in time, the price point was at 35% of the original premium. 54 cents divided by the original $1.54 comes out to 35%. So we're giving up, when we close, 35% of the original premium profit. Now, in the BCI methodology, we prefer closer to 20%. That's our 20%, 10% guidelines. So we'll buy back an option if it decreases to 20% of the original premium in the first half of the contract and 10% in the latter part of the contract. Now, on 6/21, the 26 call could have been closed at 10 cents, not 54 cents. So there was a little bit of a rush to execute this exit strategy in this particular case. And let's look at the third category now, the sell to open trade on 6/12. Well, to sell to open of the 19 call, remember, was rolled down from the 26 call, that locked in a trade loss of $80 per contract. If MGM closed at or above $19, we would have an unrealized stock loss of $4.18. We bought at 23.18, and our contract obligates us to sell at 19. Now, we do have an option credit of 338. We got $1.54 on the initial trade. We got 238 after we rolled down, sold that 19 call, but we also had a debit of 54 cents to close the original 26 call. So that came out to a credit of 338. So if you take a debit of 418 and a credit of 338, that means we have locked in a loss of $80 per contract, right at the beginning of the contract. So there was, like I said, there was a little bit of a rush. I really, really want to say that Clark did a great job understanding how important exit strategies are. But sometimes, at any given point in time, taking no action is just as important as taking action, because we're early in the contract. So closing the short call, we could wait another week to see if the price recovers. Yes, buying back the option using the 20%, 10% guidelines is very, very important. But here, spending 35% was a little too expensive and a little too early. Now, if we bought back that option and this price of the stock went up, then we would have an opportunity perhaps to hit a double. Now let's look at the next category, the exit strategy execution after the sell to open rolling down trade. Now, whenever we sell an option, even if it's after executing an exit strategy, we always put in a buy to close limit order. You never know when there's an opportunity to generate even more premium. And so the buy to close limit order at 45 cents for the 19 call is something that should have been automatic. With 20% of the 238 came to 45 cents. We're still early in the contract. So the buy to close limit order at 45 cents should have been entered. And then we can manage it moving forward. So even if at that point in time we realize, we probably shouldn't have done that, doesn't matter. We did it. And now we have to just manage our trades moving forward. As I say in my bullets here on the slides, what's done is done. We must focus on the positives moving forward. So let's summarize now. And I want to put a positive spin on Clark's trades because I do see two very, very big positives. First of all, anybody who is as focused as Clark is on managing your trades, this is a sure recipe for success. It gives us a huge advantage of all those that just buy a stock, sell an option, and pray. So I want to give Clark an awful lot of credit for being on top of it. Now, when I started teaching myself how to sell options back in the 1990s, I made tons of mistakes. I'll admit it. But they were good mistakes because they taught me. They allowed me to make rules and guidelines. And they showed me as much what not to do as what to do. So any trade that you make, there might have been errors made in how you manage those trades, are valuable to us because it teaches us what not to do in the future. And that will put an awful lot of cash in our pockets. This is exactly how I learned when I started teaching myself these strategies more than 2 decades ago. So congratulations, Clark, on the way you're managing your option selling career as you start out. It's going to pay huge dividends down the road. Okay, before I close out, I just want to mention, as I always do, that we have a ton of free resources on our website, www.thebluecollarinvestor.com. Check out our free resources link on the top black bar of the web pages. We have tons of blog articles, some videos, our free Beginner's Corner tutorial. And so all that is available for free. If you go to our blog link, you could fill in the form to get our free newsletter, which will be delivered to your email box every Sunday morning at 10 a.m. Eastern Time. In the bluecollarinvestor.com store, we have ebooks, soft and hard covered books on both covered call writing and selling cash secured puts. We have video lessons, online streaming DVD programs, calculator spreadsheets, trade planners, and online mentoring programs available to help us master these strategies. I want to thank you, ladies and gentlemen, for taking the time to tune in to this BCI podcast, number 50, Exit Strategies Must Be Timed Properly. I hope it benefits you down the road. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.